Morning once again. I'd like to start with a quote by Jimmy Dean, which says, "I can't change the direction of wind, but I can adjust my sails to always reach my destination." Ladies and gentlemen, 2024 was a challenging year, but as Standard Bank and as Stanbic Bank Kenya, we adjusted our sails. So today, ladies and gentlemen, we want to share with you our results. Despite a very difficult macro environment, I believe the results we are sharing with you shows the resilience of this brand. Good morning once again. My name is Lilian Onyach. I'm the head of brand and marketing. I'd like to welcome everybody online, joining us online. We are live streaming this. I'd like to appreciate members in the room, starting off with our chairman and our board members. I'd like to appreciate our regional CE, Mr. Patrick Mohere. I'd like to appreciate the leadership team of the bank, led by our CE, Dr. Joshua Igara. Members of the media who've joined us today, the shareholders who've joined us today, the financial analysts, my colleagues from Stanbic Bank. It's a great pleasure to have you this morning. Today, we're going to share with you our achievements and our outcome. If you're joining us for the first time, it is our tradition to always be the first bank to list our results, and we're sticking to that tradition. So I'm delighted. Yes, you can give us a round of applause for that. I'm delighted that we're going to share with you what is the outcome of our strategy. We are starting our second year of our strategy, and we'll have our group regional CE speak to that. We'll start off with our chairman, who'll speak to the operating environment. And lastly, we'll also have a panel, not forgetting the numbers. How can I forget the numbers? That will be done with the Chief Financial Value Officer. And finally, we'll have a panel that will walk us through an engaging session of question and answer. So to start us off, I'd like to invite our chairman of the board, known as Joe Muganda, popularly known as Joe Muganda, Joseph Muganda. Please welcome to the stage, Chairman, and please just walk us through the operating environment. Thank you.
Morning, everybody. Anybody who calls me Joseph reminds me of my parents. So Joe Muganda will suffice. Invited guests, our esteemed shareholders, investors and analysts, members of the media fraternity, fellow board members, Stanbic leadership team and staff, ladies and gentlemen. It's an honor and a privilege to stand before you today to reflect on our journey through 2024 and present Stanbic Holdings a full year's results. I extend a warm welcome to all of you and express our sincere gratitude for your continued trust and support. The operating landscape in 2024, like many others before, was defined by both opportunities and challenges. Globally, the economy continued to show signs of gradual recovery, characterized by easing inflation, tempered interest rates, improved supply chains, and an accelerated shift towards sustainable business practices. However, this progress was moderated by ongoing geopolitical tensions, significant electioneering seasons across the globe, and subdued economic growth in key global economies. Here in Kenya, the economic climate remained dynamic, influenced by a range of factors, including liquidity pressures, elevated cost of funding, low private sector growth, seasonal floods, and the ripple effects of the global economic trends. The country faced significant challenges, especially in the first half of the year, notably the devastating floods between March and May. I know we are looking forward to the rains. We hope they will be tempered. But these resulted in a loss of lives, widespread damage to crops, property, and infrastructure, as well as disruptions to production and supply chains. Additionally, civil protests media sparked by public opposition to the 2024 finance bill, tax proposals added further strain. These protests led to operational and logistical disruptions and contributed to Kenya's sovereign downgrade by international rating agencies in July and August 2024. However, normalcy returned in the second half of the year. The Kenyan economy is estimated to have grown 4.6% in 2024, 50 basis points below the initial forecast of 5.1%, and 100 basis points lower than the 5.6% growth in 2023. This slowdown reflects decelerated growth in some sectors such as manufacturing and construction, etc., while agriculture, tourism, and general services industries continue to be resilient. Inflation eased to 3% by the end of 2024, down from an average of 6.6% in the previous year, underpinned by lower food and commodity prices, a stable Kenya shilling, and reduced pump prices. The Central Bank of Kenya's policy rate reduced by a cumulative 225 basis points between July 2024 and February 2025, in an effort to encourage private sector growth, which remained sluggish, closing 2024 at a negative 1.4% growth. Despite these challenges, I'm proud to announce that Stanbic once again demonstrated exceptional resilience and adaptability, fully embodying our purpose. Kenya and South Sudan is our home, and we drive her growth. Thanks to your steadfast support and commitment of our management team, we achieved a 13% year-on-year growth in profitability, sustaining our double-digit momentum and cementing our foundation for future growth. We are dedicated to sustainable banking by prioritizing eco-friendly lending and investment practices, embedding ESG factors into our risk assessments, and upholding corporate social responsibility. To this, the Stanbic Foundation, together with various strategic partners, worked on programs aligned to our 4 strategic pillars, which is enterprise growth and job creation, infrastructure development and just energy transition, climate change mitigation and adaptation, and financial inclusion. These initiatives, executed alongside our business initiative, bring our vision and purpose to life, empowering diverse demographics across the country, including marginalized groups. In view of these results, I'm pleased to announce that the Board of Directors has recommended a payment of a final dividend of Kenya shillings 1890 per ordinary share. I repeat, 1890 per ordinary share. This brings the total dividend for the financial year of 2024 to Kenya shillings 20.74, considering the Kenya shillings 1.84 per share paid at interim. It also represents a 35.1% increase from the total dividend of 15.35 per share paid in the financial year 2023. This decision highlights the board's balanced approach to managing the company's growth needs, regulatory requirements on capital, and meeting shareholder return expectations. The global economy is expected to grow by 3.3% in 2025, underpinned by growth in advanced economies, moderated by potential impact of trade tariffs and geopolitical tensions. Closer home, in January 2025, global rating agency Moody upgraded Kenya's outlook from negative to positive, citing a reduction in domestic interest rates that alleviated concerns about the country's liquidity and debt affordability. This is one of many positive signals which anchor our optimism and about the opportunities that lie ahead. Our strategic focus remains on enhancing client experience, expanding our market offerings with excellence, and leveraging technology to drive sustainable growth. While we recognize the challenges ahead, including evolving regulations and economic uncertainties, we remain confident in Stanbic's ability to navigate these complexities and seize emerging opportunities with resilience and agility. We will continue engaging with our stakeholders, including shareholders, customers, and the communities we serve, to ensure we remain aligned with their needs and expectations. In conclusion, I would like to extend my deepest gratitude to all our stakeholders, our shareholders, customers, employees, regulators, and business partners for their unwavering support and belief in our vision. I would also like to acknowledge our dedicated management team, led by Dr. Joshua Wegara, and employees whose hard work and commitment have been instrumental in achieving the 2024 results. Together, we have laid a solid foundation for sustainable growth and success. Thank you for your attention, and I look forward to your continued journey together. Thank you.
Thank you, Chairman. Indeed, for Standard Bank and Stanbic Bank, we say Kenya is our home. We drive her growth. Key takeout for me, double-digit growth, total dividend of 20.74. Key takeout for me, and thank you, Chairman, for the insightful overview of the operating environment. I'd now like to invite Mr. Patrick. Patrick, I consider Patrick a Pan-Africanist. I tell him that. He's passionate about East Africa. As Standard Bank, we identified East Africa as a key growth factor. And Patrick is not just charged with Kenya. Patrick takes care of Uganda, Tanzania, Malawi, and South Sudan. And so, Patrick, your passion for East Africa and your leadership is something that we appreciate. Please walk us through the strategy and how we executed that. Thank you.
Sure.
Welcome.
Okay. Morning, everybody. And thanks for joining us this morning as we go through. I'll try to walk you through our strategy execution and just give you a little bit of color as well on what's going on. We'll start with who we are. So you'll see here that we've got a bunch of other non-banking subsidiaries, SBG Securities, there's a bank insurance, and then the foundation. But we're anchored really by the bank. The bank is our largest subsidiary. And you can see there that we've had some, a little bit of expansion in terms of our customer base. Went up almost 30,000 last year. We've expanded our distribution marginally to 30 branches. We've invested in ATMs and CDMs, but also we've continued to work on our agents and our agency network, which also helps us, again, expand our reach across our customer base. And you'll see there our purpose remains to, drive Kenya's growth, and our vision is really to remain the leading financial services business across the continent. From a global macroeconomic outlook, I think it's not lost on anybody in this room that we're going through some significant difficulty with a lot of geopolitical tensions. You might have read in the news yesterday the tariff war that the Trump administration has really put against China and Canada. And it's really disrupting a lot of supply chains and leading to a lot of confusion. And particularly, it's beginning to reverse a lot of the gains that we'd made on trade across the continent. But the one thing that gives me a little bit of hope is that when you look at East Africa, first of all, we are the fastest growing region in sub-Saharan Africa, significantly faster, close to 6.5%. Versus a continent that's growing around 2 to 3. But I think what gives me a little bit of confidence that we are going to be insulated from some of this is that we've got a significant amount of trade amongst each other, and that number is now going up to almost 40%. It stood at $10 billion in December, and that is double from the last 3 years ago. And that creates a little bit of a buffer in terms of as we see all these confusions and supply chains getting disrupted, the fact that we have this sort of network and connectivity amongst ourselves should insulate us a little bit more. I touched on this a little bit, but you will see one of the things that's also came through very strongly in 2025 on the macros was inflation was finally subdued. Every country is now under the inflation target of 4 to 5%, which is set by the central banks. And that's significant because it happened quite rapidly. It has also been anchored by a pretty good, robust GDP growth, as you can see there, with Tanzania, Uganda all close to 7.5%. And then Kenya, we talked about that earlier, the 5% growth. But even with that sort of revision that we talked about, revising Kenya's growth down, those numbers are still incredibly competitive when you look at the rest of the region or sub-Saharan Africa. There are going to be some elections in Tanzania and Uganda over the next 24 months, and we continue to face a little bit of difficulty with regards to weather and climate change. And obviously the challenges in South Sudan remain, not only just South Sudan, but North Sudan, and that has a little bit of a knock-on effect and impact with us. In terms of the themes and trends that are shaping our business, we talk about, first of all, the population. If you add the DRC and Ethiopia, we're close to 450 million people. We're young, growing, connected. The GDP, again, I said, is close to a 6% growth year on year, anchored by regional trade, and that connectivity I touched on earlier. But we haven't even factored in some of the natural resources that we're seeing in Uganda and in Tanzania. There's a significant find of oil and gas. And in Uganda, actually, they're looking to revise the growth numbers for next year close to 9% because of the significant FDI that's come into the country in the last 24 months. The ECO pipeline, which is another anchor in terms of showing the connectivity that we have, is almost 50% complete. And that's more than just a pipeline between Uganda and Tanzania. I think it also provides a trade corridor that connects those two countries all the way from Hoima to Tanga. So there's a lot going on, and we're beginning to even have more conversations around the DRC, notwithstanding what happened more recently, but the trade that anchors that, and also the coordination that we're seeing and the collaboration, all at a very senior level in terms of policy and infrastructure projects, gives us some really good stead in terms of what we're going to see in the next few years. In terms of the Kenyan macros, this is where we ended up. Obviously, agriculture and the service sectors remain the pillar of the economy. Construction, mining, and industrial sectors also are quite key, but we saw those contract, and that's not surprising. You can see in the middle there the PMI, which is our own way of tracking the Purchaser Management Index, and it does give us a little bit of a sense of what's coming in terms of inventories and et cetera. And that number, we always want it to be above 50. And you can see it did stay above 50 for most of the year. Moody's upgraded. We saw a currency reset, which we were very grateful for. And again, the NPLs remain a challenge. You can see there they remain quite elevated for the sector at 16.5%. But also what is troubling is that private sector credit growth number. If you go back this chart and go back 3 years, we used to have double-digit private sector credit growth. It was just like clockwork. It was above GDP plus. And now we've seen it contract significantly. There's a little bit of a currency exchange issue there because of the currency resetting, and so but the real number should be around 3% growth, which is still very low. It can't be below the GDP growth. So we're concerned about the NPLs and whether that's going to bottom up, whether that's bottomed out, and also whether we can continue to get some, more activity in the private sector to just sort of grow that number. Despite that, we did have a very good, we had to work in a very tough operating environment. I think everybody knows we had elevated rates, we had protests, we faced an oil supply disruption in South Sudan, flooding, the appreciation of the Kenya shilling, which was a good thing. We were relieved that sort of had, got to be reversed. And we were a key part, actually, in helping with that, with the Eurobond redemption that we were a key advisor on. And as I get to the conclusion here, this is our strategy on one page. Our purpose, we're going to drive Kenya's growth. Our vision is to, again, remain the leading financial services organization. We do deliver this strategy through 3 key pillars. transforming our client experience, executing with excellence, and then driving sustainable growth and value. And it is in that order, and it's deliberate. We think the financial outcome is a result of focusing on your clients and then being good at what you do. And we have some goals there. You can see on ROE, we want to get to 25%, keep our NPLs in a single digit, below 9%. We've already sort of almost hit that target on the cost-to-income ratio. We're now running around 44% in terms of cost-to-income. And we want to see a double-digit revenue growth CAGR of 14 to 16%. We feel that we're very well positioned for the future. We've got a number of really strong key attributes around a fortress balance sheet. We continue to have some of the best people in the market, and a robust business model that works with a lot of collaboration across different segments. And the brand remains extremely strong. We've seen that come through our numbers with significant deposit growth and significant client growth, and we will continue to build on that as we go into the future. Again, the outcomes I've already touched on those key pillars, but I think the one thing I haven't touched on is that we also have a role to play in the community under the C Impact, and we give back to the community mostly through the foundation. And we'll continue also to share with you the impact that we're having on some of the key things that we are partnering with the government that we believe are key for driving Kenya going forward, particularly around education, healthcare, women, and empowering women and the youth. This is sort of, again, just quickly to go through the pillars. So this is the client experience or client focus and employee engagement. These are just a few things to show you that we've successfully executed on. Sovereign support facilitated the 1.5 million euro bond. I touched on that. Energy sector, we've supported that oil importation up to 170 million. We've developed partnerships across a number of different pillars. We've built the middle market, which is a key piece, as we always had a strength around the corporate investment banking, but we're beginning to start to build that SME and the middle market. You can see on the employees, our diversity there, almost 50-50, female to male. Empowering our people, we've invested significantly in training and in future-proofing them for what we're going to be doing in the future. And again, we have regular employee engagement and we're getting good feedback. In terms of operational excellence, again, you can see here we've invested significantly on digital lending. In fact, we now have our own scoring model. You might have seen our new mobile banking platform, which we delivered earlier, late last year, on time, under budget, without any problems. And we're getting some really good feedback from the clients on that. The SBGS app, and you know, all that banking, core banking upgrade that I talked about. And then we talked about how Feature farmed Stanbic Bank Kenya as well to a B. And then lastly, I kind of talked about this in terms of financial inclusion and some of the capacity building that we're doing around women, the youth, investing in agriculture, which we believe, you know, again, is the biggest employer of Kenyans. So if you can't play in agriculture, you're not going to have any impact. We also have invested significantly in affordable housing, which is another key, should I say, deliverable for the current government. And we continue to facilitate trade across the region. In terms of our sort of impact, you can see there on the climate and mitigation, some of the things that we've done around planting trees, investing in infrastructure, funding the solar financing or renewable energy, which is also a key thing, and also helping, set an example in terms of ESG and recycling. And then I'll conclude by saying, all of this tied together, we did get some accolades, so allow us 30 seconds to show off. But we were the best private bank in Kenya by Global Finance. We were the best Forex bank. That's in the Kenya Euromoney. Best Investment Bank in Kenya, again, that's a Euromoney award. Best Trade Finance Platform Initiative under the CIB Awards. Best Trade Finance Bank. Best Bank to Borrow From, Think Business Awards, and Best Investment Bank again. So I believe this really confirms and cements that we are doing the right things and people are paying attention. And we're looking forward to continue to build on this traction that we've made next year. And then just in terms of the income statement highlights, so obviously revenue was down slightly, but we delivered almost 40 billion in revenue. We would have liked to see that number grow, but there were a lot of headwinds, and we talked about that. Our net interest margin came in at almost 5.7%. Cost to income ratio, I talked about it. ROE is close to 20. But I think what's really important is the operating leverage in our business because, excuse me, even with that low revenue, we're able to see a 13% growth on the bottom line. And more importantly, I think for most of you in this room, we grew our dividend per share by 35%. And our earnings per share really is really the same as the profit growth. And you can see the ROE evolution there at the bottom over the last 5 years or so. So I think in a nutshell, these are good results given what we went through. So we are proud of them, and we are looking forward to building on this for the next 2025. Thank you for listening. Much appreciated.
Thank you, our regional CE, Mr. Patrick Mohere. Positive expected performance of GDP of over 5%. I think for me, the key takeout, it's not just about the financial performance, what Patrick has walked us through, but it's about the sustainable business. It's about the work we've done around financial inclusion, sustainable finance, affordable housing. But also something that is very important, and when our panel get on stage, possibly these are some of the questions that would be asked, is our investment in the digital space. Patrick has talked to the investment in our core banking system. I'm very proud to be a member of this team, actually. Rarely do you hear a bank going through a core banking upgrade. On time, on budget, in many ways. So really, congratulations to the team, to the Stanbic team, and led by Alex in delivering this. And really, the investment in digital, therefore, positions us very well in terms of client experience and really competitiveness. But I'd now like to invite the man behind the numbers. There's a lot of detail. I'm in awe when I listen to this man. I tell him he's not just an accountant, but he sees beyond the balance sheet. A visionary leader, a man who can tell a story behind the numbers. Mr. Musau, karibu on stage.
Good morning. Technology tried to play a trick on my chief executive there and gave him some numbers to present, and he did a very good job. Thank you for joining us. Really, really proud to share some thoughts about how we performed. Thank you, Chairman, for just sharing a view of the environment, and Patrick for painting a picture of how we execute our strategy. Before I talk to the numbers and the ratios, let me talk you through the income statement. Our income statement shows a 5.1% decline in net interest income, a number that I'm particularly very proud of because in the environment, in the liquidity environment we operated in, that number would have been significantly worse were it not for certain things that we did. If you look at the gross interest income went up 27%. Rates were rising, repricing was happening, especially on the market-linked instruments, and therefore that came through. What happened, however, is that interest expense went up 93%. And that just demonstrates two things. One, a difficult funding environment, but then two, we did take a deliberate the decision to protect our customers, especially those on the lower LSM, from high interest rates. So we delayed some of the cost of funding transfers to our customers and protected our customers. And you will see that peers much later into the credit impairments, because we didn't just make the money and lose it on the balance sheet. So that explains the 5.1% that you see in year-on-year adjustment. On non-interest revenue, of course, that line has two. Okay, thanks. So on non-interest revenue, we are at 1.7% down year on year. Of course, there are two entries there. There's net fee income, which is the transactional fees, a net of interest expense. That remained relatively flat. Now, why is that a good story? When we spoke last year, we had executed one of the biggest transactions, fee-earning transactions in 2023. So that sits in 2023. And therefore, looking at 2024 relatively flat is actually a good story to tell. And when I look at the transaction activity that we had with our clients, our client volumes and transactions actually went up 6.1%. So very happy with that outcome. The other component there is trading income. Trading, of course, has FX, but it also has money market trading. Relatively flat, but if you just open it up a little bit more, FX income actually went down 22%. So we compensated that with a bit of money market trading, especially as rates were coming down towards the end of the year. That is what gives us a 3.8% reduction in total interest income. And then there's operating expenses, 2% down year on year. Are we starving the organization of investment? I'm glad the chairman and the chief executive talked about some of the things that we did to invest in the business a lot more. There's a bit of adjustments in those numbers. If you look at the base in 2023, there's a big operational event investment provision that we took in 2023. The 2024 numbers are adjusted of FX. So again, if I adjust the base and I also adjust 2024, the growth in our operating expenses is about 6%, which is about inflation plus. Demonstrating that we are continuing to invest in the business, as the chief executive spoke to. Our impairments went down 50%, and this is credit to our client relationships, our origination capabilities, our monitoring capabilities, staying close to our clients in difficult environments. Again, of course, there's a bit of a story behind the numbers. There's in the base, there are some names that were giving us trouble in 2023. We did take some impairments on them, increased our coverage ratio to just over 60%. I've kept it there as we continue to resolve some of those names. The 2024 number has a bit of adjustment in currency also, because the currency appreciated. 45% of our NPLs are in foreign currency, and therefore there's a 700 million currency adjustment in that 1399. And that is what actually gives us, the profit after tax increase of 13% that was spoken to. So if I go back to the ratios so that they now make sense, revenue down 4% or 3.8%. I've explained how that happened. Net interest margins, despite all the protections we did to our customers, managed to bring it to about 29 basis points, a reduction from 5.97 to 5.68 this year. Cost to income ratio ticked up to 44.6%. Very, very happy with that. Last year, that number was 43.4%. If I flattened the revenue year on year, that number would have been 40.9%. So very happy with the work that we are doing to improve efficiency in the business. Our credit loss ratio is a story of the year. We've managed our credit impairments quite well. I mean, a lot has been said about no growth in the market. A lot has been said about impairments, NPLs continuing to be sticky, and I'll show you a little bit of that. But our CLR at 1.16% is actually something we're very proud of. We like that number to be below 2%. So that 1.16 is within that target. Are we taking too little risk? No. In fact, if you adjust that number for currency and a bit of base effects, comes to about 1.8%, which is around the area that we have set our risk appetite and would like to operate within. Profit after tax of 13%, ROE up to near 20%. I know we've been looking forward to get this to 20%. Patrick, we're on our way there. And then earnings per share are growing alongside there, and very happy with the director's decision to award our shareholders a decent increase in return. Looking at the balance sheet, again, let me look at it this way so that it will make a bit of sense. So our balance sheet stable. That's how I would describe it. Yes, it shows 1% decline, but actually our average balance sheet throughout the year was up 13.3%. So there was much more activity on the balance sheet throughout the year than you see on the spot. And part of it is because we've got some heavy clients and heavy transactions that take cycles. So depending on where the year end finds the cycle, you could have a big lift or a big dip. Particularly picking up on the loans, down 30 billion, i.e. 12%. Out of that 12%, 7.6% is currency appreciation. So nothing to do with transaction activity, just motoring on with the way the macros has behaved. On the liabilities and funding side, largely stable. Customer deposits relatively stable at just 1% down year on year. And in a year where we saw, and when we analyzed the Q3 results, we saw all manner of movements in customer deposits and balance sheets in the industry, allocation of capital between customer franchises and other asset classes. Very, very happy to see our deposits remain largely stable. So again, taking you back to the ratios, balance sheet total largely stable. Customer loans, I've explained that. Customer deposits largely stable. Non-performing loans, 9.1%. We're working steadily towards the 9% target that we've set for our strategic horizon 2024 to 2026. We were at 9.47 last year, so very happy with the work that has been done. I've spoken about currency, so I'm not going to stop now that it's going the other way. But still, even if I adjust for the currency appreciation impact, our NPL ratio is still 9.28. So still happy with the outcome that we've delivered. Liquidity ratio, quite liquid. The regulator requires us to keep liquidity ratio at 20%. We are at almost 2.5 times that. So very happy with how we manage liquidity. And we remain capital adequate. So at 18% against the regulator's requirement of 14.5%, we're quite comfortable. The house comes together through these various entities. So the bank operations in Kenya grew 18% through some of the explanations I've given. South Sudan went down 63%. All of us know the challenges that South Sudan as an economy, not just the enterprise, has gone through. We do hope, and I've received some assurances that the oil is going to start pumping again, and we're looking forward to seeing that correct. There's an asterisk there, which just explains that number is pre-hyperinflation. South Sudan is accounted for through under an accounting standard which requires the numbers to be adjusted for change in monetary value. But that number is is before hyperinflation, and therefore it's real management performance. The Stanbic Bank Assurance, 19% down year on year. This business had a one-off adjusting event in 2023, where some of the big policies that they book was booked for a period over 1 year, which has not repeated in 2024. So that's why it's behaved like that. But very, very happy with the work that's happening there. SBG Securities, 20 million. Very, very proud. I mean, that business has two businesses in it. It has a traditional brokerage business, which has continued to do very, very well. 87% down looks scaring. But this is a business that intermediated that big transaction that we talked about last year. I hope you haven't forgotten. And therefore, we didn't expect that to repeat. But that is also the business where our new kid on the block in terms of businesses and availing opportunities to our customers has come in, the asset management business. We started that business on the 3rd of September in 2024. By the end of the year, we had gotten to assets under management of just under 2.5 billion. I am told we are heading towards 4 billion as we speak. So some great work going on there, but also a dividend of the trust that the chief executive spoke to, that our customers have on us. So as I close, what do we see and what's the outlook? We're going to continue executing our strategy along the strategic pillars that we've set. The market will give us opportunities in 2025, but it will also give us a fair share of challenges, and we do expect and are ready for those. And if you pick the U.S. Comments that the chief executive made, there's a lot to still unravel about what's that going to mean for remittances, which are a big source of currency flows. What's that going to mean to some of the sectors which are supported, health, etc. But we're going to have to respond to that. On people, the chief executive has spoken about our commitment to invest in people. We're going to continue investing in people because they're really the software behind serving our clients. So we're going to continue on that. We're going to continue being risk resilient. The market is going to give us risks, whether it is credit, financial, non-financial, and we're going to continue investing and bolstering our firewalls and war chests to deal with those. We're going to continue investing in operational excellence, digitizing as much as we can, operationally and externally, in terms of how we serve our clients. And we do hope that those lead to delivering sustainable value for the shareholders, for the communities we serve, and for all the stakeholders that we interact with. Thank you very much, and I think the technology is not playing any tricks on me.
Thank you. Thank you, Bwana Musau. I mentioned that we adjusted our sales. Musau's walked us through the numbers, double-digit growth, cost management, quite key, risk management, balance sheet optimization, but also the investments that we made in digital. We are now moving to really the engaging part of the session today. It's the Q&A session. I'd like to invite my panel onto the stage. Yes, please have your seat. Yes. Okay. Mics. Okay. Ladies and gentlemen, we'd like to take on any questions that you would have for us. Questions on the outcome we've presented today, the 2024 numbers, questions on our 2025 outlook and the strategy that we set out to deliver, the 3-year strategy. So kindly, we do have mics in the room. Please raise your hand and a mic will get to you. Say your name and the organization, and kindly speak a little loudly so that the panel can hear you and respond to the question. So starting from that corner. We can't quite see you, but please state your name. You're behind the pillar.
Thank you. Good morning. My name is Ritesh Bharat. I'm an investor, and it's not particularly a question. I think just to set the tone, I'd like to say a big congratulations to the leadership of Stanbic Holdings, and to say thank you for always maintaining a wonderful dividend payout. And we are very grateful to you for, of course, the outstanding performance for the year 2024. But this has been a very encouraging dividend payout you have announced. So I hope that the share price starts rising even further. Thank you.
Okay, we do have another question on this side of the room. Can we get a mic to this side of the room? Please raise your hand. Okay, your name and the question.
Hi, my name is Isabel Chakairu from Sterling Capital. My question goes to Mr. Musau. Could you break down the gross loan book proportion for the different interest rates, meaning what's the cost plus model, contribution, Stanbic prime rate, market observable rate, and any other split? Thank you.
Okay, go ahead.
Okay. Thank you very much, Isabel, for that question. So I'll break the balance sheet into the currencies. The foreign currency balance sheet is largely on a floating rate model, mostly linked to SOFR, and that's about 35% of the total loans. So that's that piece. When I look at the local currency balance sheet, allow me to break that down for you per business unit, because it's different. It might skew if I give you the totals, because it's different balance sheets. Different units have different sizes of balance sheets. The corporate balance sheet is entirely, or 98%, on the market observable rates, so T-bills. The business and commercial balance sheet is 48% on cost plus model, so the risk-based pricing, and the other big chunk is on a T-bill rate, or T-bill or other market observable. And then the third one is our personal and private banking. 82% of that balance sheet is on risk-based pricing, and then the other smaller chunk is on observable market rate. Does that help? Fantastic.
All right. Looking in the room. There's a question. Julian?
Thank you very much. Good morning, everyone. My question goes to the regional CEO. 2025 is the first year for bump up in core capital requirements following the amendments to the Banking Act. What sort of conversations are you having? By end of December, we should be having it at 3 billion shillings. Thanks.
We're ready now.
Patrick, you can go ahead.
Yeah, I mean, I think if you're asking whether we're having conversations with other banks, not really. But as you know, we're already well and adequately capitalized. We'll be observing to see what happens in the marketplace. But I think it was, long overdue to sort of build some more strength into the capital system. So we're just observing it from afar, and we're just hoping that all the banks will be able to meet those guidelines. Thanks.
Okay. Yes, there's another question right here. Yep.
My name is Ochieng Olu from Think Business. Now, I'm looking a little more long term here. Just sitting back and looking at your growth over the last 5-10 years or so. The first statement I want to say is that I believe you cannot shrink your way into greatness, in the sense that it's been flat quite a bit for Stanbic Bank over the last 10 or so years. Market share, actually, if you look at certain parameters, your market share has actually shrunk. And looking at these results today, it's clear that there is no aggressive growth plan. Maybe you are risk averse, which is fine. Sorry, I have a cold. So my question is this, yeah? And I know somebody spoke before me and spoke about the expected changes in the market as a result of the new demand to increase capital for the banking sector. And my question is, your vision statement says to be a leading bank, but I think when your CEO was speaking, he actually said to be the leading bank. So I don't know exactly which one it is, but I wanted to maybe it is to be the leading bank. Your last merger was with the CFC. That's many years ago. Standard Bank is a big player in the African market. Is this what you're going to see year in, year out? Is there any serious plan about scaling up, or this is it?
I think I'll ask Josh.
Thank you.
Definitely take this.
Yeah. Thank you, Ching. And obviously you follow the industry very well, but I will correct you on the data points. Actually, the only two banks have increased market share in the last 5 years, which is Stanbic and one other bank. So I don't think your data point is actually correct. I've been in the industry for more than 10 years. Shifting market share is not something that you see significant across industry. And I've been a captain of industry for many years. And our growth has been very strong, actually, growing at over 30% year on year until 2024. And it's the dynamics of the market. If you look at this, is the first time, Ochieng, that credit growth is decelerating in the industry since 2009. And it's very significant. It's a question we always have at the industry level to say, obviously there are reasons for it, tightening of the monetary policy by the regulator for good reasons, dealing with inflation, and that's material issues. But we believe that with the adjustment at the MPC, you will see an action and rates by industry, you will see credit growing. Generally, credit grows 2x of GDP. So the number that Patrick showed of minus 1.4, it doesn't concern me personally. I think last time we saw this was 2007. Yeah, and I am a strong believer that you build your business by anchoring your organic growth model. So what are we building? So 4 principles for the bank. Our corporate business, quite strong growth, if you saw the numbers. Activity at 13% last year. We believe we can grow that business this year at 14 to 16%, which is our largest business. Our private banking business, which we are anchoring very this year, we think we can be able to build that business at the same level of growth this year. So I think the nuance for last year, Ochieng, is to say, we're also very pragmatic. If industry is decelerating, our investment in credit is not the approach to grow our balance sheet. I think it's important to manage that portfolio very well. Now, and obviously industry is going to continue to grow this year. I am very much optimistic, actually. The bigger question you ask about what is the action for inorganic, I think medium banks, so just give you some data points to be much more transparent and maybe give you some kind of advice. Medium banks and smaller banks are not appetite banks for larger institutions. Because actually what you have is your banks at 5% market share, banks at 2% market share, banks at 1% market share. 14 banks already comply with the guidelines. So from our perspective, we don't see that as an approach in terms of how we want to grow. And that's how I will see it. So the vision you had from the last former governor, Patrick Njoroge, the current governor, Dr. Thuge, ultimately you will see more growth organically for larger banks, the top 9 banks. That's where we belong. If you're going to look about another action, it will be for the smaller banks, but I'll let Patrick have the final word in terms of how that runs.
Patrick.
I guess So I'll just give a little perspective again from a regional perspective. We are now officially the second largest bank in the region on profitability. We grew, I think, 25-30% the last couple of years organically. So our strategy is working. We are leveraging our brand and our clients are trusting us. And we're trying to extract synergies from all the other countries within the region. So that's where we're focused. And I think it's continuing to pay off significantly. And even in the mid to long term, we sort of see that 25-ish% growth continuing, unless there's some really, really disruptive macros that come into play. So I think we're not going to be confused or destabilized. We're going to just focus on what we've been doing really well. And I think it will continue to show it in the numbers that we demonstrate. Thanks.
Okay, thank you, Patrick and Daktari. Looking across the room. There's a question here, please.
Morning, everyone. Justin from SBG Securities. Mine is more short-term. What's your 2025 outlook in terms of numbers, especially around cost of funds, which more or less doubled last year? So are we looking at going back to below 4%? And then on credit growth, we expect currency stability. So with that, then what's your loan book growth target this year? And possibly if you could share also your profit growth target. Thank you.
Yeah, thanks, Justin. So there's a base case for cost of funds. I think directionally we think the lower rates are going to provide some relief on the cost of funding that we have seen in the market. The bear case would be if certain things change, if we continue to see appetite from the government to borrow from the domestic market, depending on how that's going to pan out, we might see that continue to start turning upwards. Inflation is low. It's still at on the lower end of the range. So from a policy perspective, we don't see that being a risk. So that's what I would say on that. On credit growth, I think we've kind of hit the bottom, and part of the signals we are seeing in January and February suggest that deferred investments, clients who had kind of deferred some investment decisions, had deferred some spending decisions, are starting to come back and want to start that. So we stand ready to support them. So we expect credit to grow. Thank you.
Thank you, Bwana Musau. Are there any other questions in the room? Scanning the room. Bella, I would have been surprised if there was no question from Bella.
Thank you for your presentation. I just want to know what you mean, Dennis, by you expect more credit growth. What do you mean? If you could share numbers or a range or a target if you have. Thank you.
I can add on that. So, well, if we look at the numbers, really, local currency credit growth last year was close to 4%. And our market has a lot of history. So when the rates are high, which is what we saw a couple of years ago in 2015, credit growth actually decelerates from what we see. If you remove the delta adjustment for currency strengthening, for foreign currency loans were down 10%, and just because of the adjustment of currency Patrick spoke about. So we anticipate as rates come down at the industry level, we should see that growing back into the double digits, actually close to 8 to 10%. Across all segments, large corporates, if you look at key segments, infrastructure, which has been much lower. And I would say, Bella, maybe three aspects which I wanted to comment on. So the sovereign is doing the right things to address some of the bigger challenges it's faced last year. And here, sovereign meaning government of Kenya. So ultimately, as they start acting early on liability management for themselves on the long-term bonds coming through and expanding revenues for the fiscal side, I think you have got much less crowding out going to happen going forward this year, which was a bigger challenge for 2024. The second item, then you have more credit going on. We are excited, Bella, to see the new kind of facilities clients are coming into in terms of activity this January and February. So that's the second part of what we see. The last part will be largely your enterprise clients or SMEs, where largely because of the delayed payments and what we see as pending bills. And you see a lot of actions, particularly from road authorities, to deal with some of those gaps which have happened. So, Bella, it's important to look at your drivers, which anchor the growth momentum for credit. And therefore, when you talk about 8, so the first half will look slower, but I'm sure that because generally this market grows at 10 to 15% annually, I am confident that this year, especially with the currency where it is today, Bella, we should see that going to 8 to 10% as we go into the second half of the year. And I've said about actions by sovereign, which we are able to see, revenue measures that are happening this year. So that is what I will summarize for you. And also we are seeing now, a lot of foreign currency lending, which was in there last year. Those will be the 3 measures I would say to support them. So when we say 14, 16% revenue, I think we see an 8 to 10% growth in credit by 2025.
Thank you, Dr. Maybe 1 or 2 last questions. Please bring the mic to this side. Yeah.
Thank you. Congratulations, Stanbic, for your wonderful performance full year. My name is Jesse. I'm from one of your fellow banks, KCB. I just have 2 questions. I hope you don't beat me down for that. One is, well, you have explained your loan book picture. I was just surprised what was happening quarter on quarter, because as at quarter 1, 2024, you guys were pretty good, 355 billion. And I think aside from the FX story, you have tried to paint a picture of the other factors affecting the market. We also what happened on the macroeconomic front. So from where you sit as Stanbic, what do you think would be particularly different in 2025, aside from what you've already mentioned, which would be the overall macroeconomic, shocks? And then I'm also going around trying to find out from various banks, basically, what's your outlook around the risk-based pricing model? How do you think that will affect not just your bank in particular? You can talk about your bank, but also what is your view about that? How will it really impact the entire sector? Do you think it will be a significant impact, or it would rather be minimal? Thank you. Okay. Congratulations once again.
Thank you.
Jesse, thank you for the questions. Let me just try and be quick on both responses. So on this last quarter, actually quarter 3 and quarter 4, we have a number of the short-term facilities for our clients, largely on oil and gas segments, that largely were maturing in quarter 3 and quarter 4, to be specific. And they are very short-term facilities. I think KCB is a big player in the oil and gas segment. And that's specifically to answer your question about the adjustment quarter on quarter. But those are renewing facilities that you will see now in quarter 1 and quarter 2 this year. And I would say that's maybe the only delta change you'll see in quarter 4. In terms of risk-based pricing, it's more of a difficult question. So we are all, as industry, disagreeing with the central bank around the risk-based pricing. But remember, we are the one who created the models and got them approved. So it's a difficult question to say. But I must say that sitting at the governing council, we are positioning with the regulator to make amendments and review for the risk-based pricing this year across industry, not just for ourselves. We think that it's valuable for us to have an instrument that is much more accretive to market, that is not too blunt and adjusts. Yeah. And so we have this whole issue that you're using a market observable rate and a cost-plus model. But I must be careful, Jesse, because these models are already approved. Yeah, and therefore, the regulator will have to take a final say. We do have a working session. I actually salute the actions by the governor. We believe that if we are able to remodel, and what's the difference today? We have different price points in industry because of every single institution has had a different kind of rate. We believe that we need a reference rate for industry. And this is something that is being engaged at industry level. More like your SOFR-based model for foreign currency. That's what we need to be able to see. Today, we have 40 banks, different kind of pricing. There are 40 different models. And I know that by the end of Q1, there is an action. So without providing, raising questions to challenge a regulator who have a lot of credit for, let me say just it's time to wait and answer these questions in May.
Okay. We only have time for one more question. Just one more question if there is a question in the room. Oh, right there.
Thank you. My name is Daniel, and I am a shareholder, a passionate one indeed. And as a shareholder, I must say that we are very, very much grateful because of the excellent results, and not only the results, but also considering that you are giving shareholders a lot of money in terms of dividends. We are indeed very grateful. You know, when I started investing in this share, I think it was below 30 bob. And now when you see that it is going almost 5 times, it's a sign that maybe we might get rich when we are still young, or not very young. So thank you very much. I want to thank the management and the board. You know, we sit down and we allow you to work for us. And like the good book, the Bible, that says that somebody was given 5 talents. And then when he came back to the master said, we gave you this to do business. Bring what you have done. And I think we should commend you, and we are so much grateful because of the 18 shillings and I think 75 or some thereabout. And we can only say that you have our full, we have confidence in you, and you have our full support, and we are expecting that one day, not far away from here, the share of Stanbic will hit 300 shillings, and then we'll be very, very much happy. There's nobody who is satisfied with what we have. So as much as now the share is trading almost 5 times from where I bought it from, I'm expecting now 5 more times from there. So thank you very much. Thank you very, very much. We as shareholders, we are very, very grateful, and you have our pat on the back because of what you have done. Continue doing the good work. Thank you.
Thank you, Bwana shareholder. Is it a burning one, Mr. Chair?
I thought you said one more question, but that wasn't a question. So let me I think it would be unfair if we left this place without addressing the geopolitics, what is going on around the world. Listening to Trump this morning addressing Congress, I think the truth is a lot of what's going to happen in the geopolitics and the global macroeconomic environment will be determined a lot by what happens with Trump in the US. Of course, the good news is that we are likely to see, we're going to see the Ukraine-Russia war ending. But I just want to get some thoughts from the 3 gentlemen sitting over there in terms of what is their projection going forward. This is just, I think, 6 weeks into Trump's presidency. There is no knowing or telling what Trump will do tomorrow. Are you very clear about, especially your strategy, sailing smoothly as you laid it out? What are sort of some of the contingencies? What are you looking at? Africa has already been hit, obviously, via USAID. I know that you also have some of your clients who obviously depended on USAID. So I just want to know to what extent, what contingencies do you have? What is your planning around the changing or fast evolving geopolitical environment?
Okay.
I would attempt that, and Patrick has a better view actually. But Ocheng, I think the good thing about Trump is that he's unpredictable. I don't think you will know how he will make a decision tomorrow. And in that case, there's some value in that kind of leadership. It's a new world order we are facing today. The model where you kind of estimated where the world is going. And it's not just Trump. I think we are seeing this a lot even in Central Europe. So our view has always been, even as he decides to put tariffs today, he can change tariffs tomorrow. So the most difficult job, speaking to African economists, is to anticipate Trump's waking up. How does he wake up tomorrow? That's the most difficult job we have. We don't have that answer. But I would say from what we anticipate, from our global geopolitics across the continent, 2 countries are very close to Trump on the continent. One happens on the north of Africa, which is Egypt, and one happens to be in the east of Africa, which is Kenya. These are the 2 geopolitical centers for Trump. And rarely have you seen him done a lot of attack on these 2 countries. I mean, we have difficulties down south, difficulties down west. But I would say that where our biggest issue, and if you ask Edwin, our Chief Risk Officer, our biggest issue is gone around the supporting programs around the international development. USAID is a massive problem for us. It's $1 billion almost for Kenya, $843 million this year. And that's a bigger challenge. You know, how does the sovereign finance healthcare programs, you know, malaria programs, HIV programs, what are we going to do for the jobs, many people in our markets? That's where we see as a bigger concern for us. Tariffs, naturally for us, we don't see that as a massive issue unless they are global tariff. So we see two kind of problems in tariffs. One, and we had these conversations with the National Treasury, the economists, just this Monday. So when you have targeted tariffs, so Canadian tariffs, Chinese tariffs, this one don't have a massive impact for us. When they're universal tariffs, and that's a bigger problem. We haven't seen that action. So that's a global tariff, like AGOA removal, for instance. That would be a massive issue to worry about. We don't think that Trump will make that move without getting Congress into the engagement. So we are spending a lot of our time, and Gibran, who, if we can refer him to you, is one of the most acclaimed economists on the continent. He has called a lot of these economic models the last 10 years. And we are giving his advice to the National Treasury. So we believe that may be much rare. How we deal with this gap for the development finance, that's where we think we don't have a bigger view. Our impact as Stanbic is not as high in terms of our clients. But we believe that we don't have an upside, neither do we have a massive downside. That's where we sit from Kenya. But obviously, if we think about Uganda and other countries, the conversations, South Sudan, it's materially complex. It's $1 billion for South Sudan. Everything runs on the UN support. 80% is for the US government. So that's a model we're going to be able to see. I can't comment about what... In fact, we laugh with the economists because he says it can be unpredictable today, and maybe that is the strength about Trump regime, and we can't tell what tomorrow will be. I'll hand over back to Patrick for a bigger view.
Thank you, Joshua. I think you've hit most of the points. But I think we expect Trump to self-correct at some point. If you think about, tariff wars are generally have no winners. So those 25% tariffs is imposed on China, Mexico, Canada. They've had almost similar tariffs placed on the US. It's going to backfire in a way because all those prices will then work themselves into inflation, and it will bring into some overheating of the economy. So I get the feeling that after a few months of playing this gamemanship, there might be some correction or some adult supervision in the room, and we'll see some changes with regards to policy. But the thing about, with regards to the US kind of taking a back seat from leadership and investing and supporting the continent, it is a bit of a concern. We do expect that some of that might be taken up by other partners, and we're having conversations with some of the other partners. We're seeing a lot of liquidity from the Middle East corridor with interest in Africa. The Chinese will continue to play a role. So the hole might not be completely filled, but I believe that there will be some other stronger partners to step in, because ultimately, Africa remains one of the most attractive places to invest in the midterm, with all the demographics, young population, growth, big consumer market. So you can't really ignore it for all those reasons. So I remain cautiously optimistic that we shall muddle through this little phase that we're going through. Thank you.
Thank you. Thank you to our panel members. Before I release you, I know I didn't have Joshua earlier on stage, and I want to give Joshua an opportunity as your parting shot. Second year in the bank, year 2 of your One Stanbic strategy. Significant growth we've seen over the last couple of years. What is driving this momentum? What should we expect in 2025 from the bank? Parting shot.
I will summarize, Lillian, that this year has been a year of resilience for us. And I think that's really listening to our shareholders for the holdings, that's really what matters the most. In an environment where a lot of shifts and mini shocks have happened, I always feel that when you see industry credit decelerating in our economy like ours, is a concern that always everyone gets nervous about. But Kenya has been a very resilient market, and Stanbic's strategy remains solid in this environment. And the actions, what I get impressed is as rates, come down, obviously there's been a lot of challenge from the regulator that we must act quick on rates, and banks have responded in this month, including Stanbic. We've added new rates now for 19th of March. I believe that gives momentum or vibrancy in the economy, and therefore we should see an uptick of our growth, of our assets, of our earnings this year, and that is a good chance for us to be. So you measure the strength of our strategy in resilience when there is crisis, like last year.
Thank you. Resilience, ladies and gentlemen. I'll now release my panel. Thank you, ladies and gentlemen, for a very engaging session. I can release you now. Insightful questions, active participation. And as we close the day, on behalf of the management, I would really like to thank our shareholders, our clients, for choosing Stanbic Bank as your financial partner. I'd like to thank my colleagues for the dedication and the results that we've shared today. As our executives have affirmed during the session today, we are here to serve our stakeholders and are committed to delivering our strategy in a sustainable way. So thank you for your attention and your participation today. As we come to the end of this program, we are going to have a closed session of media interviews. So the media team, we do have spaces, allocated rooms for you to conduct the interviews. Thank you very much for joining us this morning, and we'll see you again in August for the half year. Thank you. For my panel.